Hello and welcome to Intermediate Accounting. Before we go to the topic proper, we have to discuss what is Intermediate Accounting. So this is just an introduction of what to expect in the subject Intermediate Accounting. So firstly, Intermediate Accounting is one of the main subjects of financial accounting and reporting. It is one of the six CPA board subjects that is given by the Board of Accountancy. So, what is the discipline of financial accounting and reporting? This discipline is the subject in which we study the proper preparation of financial statements. Now, I understand that you already had your accounting one in which you've discussed the basics of the accounting cycle. Now, for financial accounting and reporting, this is where you understand the proper preparation of the financial accounting, the financial statements. Now, aside from that, mostly we will be discussing about the line item presentation. So, what is line item presentation? Now, line item presentation discusses that line item should be grouped into a single reportable account. So as opposed to your accounting one where you have a lot of accounts in your financial statement, for financial accounting and reporting or intermediate accounting, as they say, we have line item presentation. So what are the examples of this? So let's say for example, cash in bank, cash on hand, cash fund, and cash equivalents, those are all items of the same nature. So when it comes to your financial statement, you will not report them separately. So you will report them in a group. Okay? So we call those group or group of cash, cash and cash equivalent. Now for receivables, we have another group, trade and other receivables. So there are a lot of line items that will be discussed here in intermediate accounting that you have to understand. Now, next, there are certain accounting terminologies that you should understand. Okay? So, primarily recorded or recording, recognized, derecognized, realized, unrealized, disclosed or disclosure, measurement, silent, offsetting, cost, or carrying amount. Now, these are terminologies that are commonly discussed in the subject intermediate accounting or in the accounting profession itself. So let's start one by one. So what do you mean by recording? So basically recording means, okay, this is where you journalize. Okay. So when you say that the item has been recorded, this means that it's already been journalized. Okay, so a perfect debit credit has been prepared, and okay, of course, if it's journalized, then it was posted and then it is presented in the financial statement. So once it is recorded, this means that it is already reflected in the financial statements. Next, recognize and derecognize. Now, basically, recognition, it's just like recording. Okay? Now, the difference is that recording is a more, what you call this, detailed term. Okay? When you say record, it is journalized, therefore it is presented in the financial statement. When you say recognize, this is the act of including a transaction or an account in the financial statement. So, when you say we recognize that asset, this means that we include that asset in the financial statement. Okay? So, this means recognize means inclusion. Okay? And the recognition, this means that it should be excluded. So, when we say we recognize let's say for example, we recognize an asset, this means that we record the asset in the financial statement. We include that in the financial statement. When we say you should recognize that asset, this means that you should remove the specific item in your financial statement. So that is for recognition and derecognition. Next, realize and unrealized. When you say realized, the idea of realize is to be turned into cash. So, when an item or when a transaction is realized, this means that it was turned into cash. Okay? And when you say unrealized, this means that your income or expense hasn't been turned into cash. Okay? So the idea here is was it turned into cash or not? So if when we say realized, it was turned into cash. When we say disclosed, this means that it is not recognized or it is not recognized in the financial statement but was disclosed in the notes to financial statement. Okay, included in the notes to financial statement. So what's the importance of this? So when you say recorded, it is included in the asset, liability, equity, income, and expense section of the financial statement. When we say disclosed, it's just a notification of some sort in the notes to financial statement. This means if an item or a transaction was disclosed, this means it has now effect in the financial statement. It does not add your asset or deduct. It does not increase your liability or it does not decrease. It has no effect in your financial statement itself. But there are items that you need to, of course, disclose. Okay? Next, measurement. When we say measurement, okay, so we took measurement in a sense that if you recognize an item, okay, if you recognize an asset or liability or equity or any income or expense, if you recognize that, when we say measured, how much is it recorded? So let's say, for example, cash should be recognized. So when you say cash should be recognized, the cash should be included into the financial statement. Now, the next question here is, at what amount? Okay? So, if the question here is what amount, then therefore, you go to the what we call measurement. Okay? So, when we say we measure, we put a specific amount in the specific elements of the financial statement. Okay? Next, silent. When you say silent, there is no so what you call this, there is no statement that proves or disproves anything. So when we say silent, the problem does not indicate anything. Okay, so if the problem is silent, meaning the problem does not say anything. Okay, so what is the importance of silent problems? Because we have what we call assumptions in initial assumptions in recognizing financial statement. So let's say, for example, notes receivable. Okay, now we all know notes receivable should be measured depending on its due date. So if it's within 12 months, then therefore it is current. If it's beyond 12 months, it should be what do you call this, non-current. What if it says the problem is silent? So when you say it's silent, there is just a notes receivable or payable, but there is no indication on its due date. So it may be 12 months, it may be more than 12 months. So it does not state anything. So in that sense, when we say it is silent, this means that the problem does not state anything. Okay? Next, offsetting. When we say offsetting, this means that asset and liabilities are deducted to each other. Okay? Now, what is the rule of offsetting in the conceptual framework? Offsetting is not allowed in the recognition of financial statement. So, if you have an asset, report it as an asset. If you have a liability, you report it as a liability. Do not deduct your liability to your asset. Okay? Offset. Okay? Next, when we say cost, this is the value of an item when it was acquired. So let's say, for example, you bought a cell phone 5 years ago. So how much did it cost? Okay? So when you say cost, how much is the purchase price or the acquisition cost? Okay? And when you say carrying amount, this means that how much is it now? So, of course, if you purchase an asset or liability 5 years ago, you purchase it at a different amount. When it comes to today, what is the existing value of that specific asset or liability? So it changes. So when you say cost, this is what we call historical cost or the acquisition cost. When we say carrying amount, how much is the value today? Okay? So these are the specific terminologies that you should be mindful when we take up